Hi, good morning, everyone. Thanks so much for taking the time to join us this Friday morning. And yeah, so today we've got Shao-Ning with us. She's the partner and an angel investor as well. I won't give too much away. I'll let her introduce herself later. Um, so a little bit about the deals that's coming up on Leet Capital. So Leet Capital is our equity crowdfunding platform. So we've got two big deals coming up. The first one is the Green Factory. They're basically a 29-year-old manufacturing company, and they do sustainable manufacturing. And so now the new generation wants to digitalize the business. And so that's the next plan. And so for that, they're raising 5 million ringgit. And the other one we have is Green Lagoon, which is a renewable energy company. So what they do is they take the palm oil mill waste and they convert it into biogas and then eventually renewable energy as well. And they sell it to the national grid, so TNB. So they're doing what is right now the largest ECF deal ever done in the country. So they're raising at 15 million. So if you want to check both of these deals out, you can either scan the QR code there or you can head over to our website. So a little bit about Leet Capital. So we are, like I said, an ECF platform, an equity crowdfunding platform. And we're one of the latest ones that got our license. So we got a license early 2020. So we're one of 10 ECF operators. But how we're different is that we are part of the 1337 ecosystem. So for those of you who don't know the 1337 ecosystem, we do other stuff as well, right? So we run accelerator programs for startups, and then we also have a VC, which is 1337 or Leet Ventures. So we run the accelerator, and then we sort of fund that those the startups as well as other startups that come to us as well. And these are normally very early stage startups. So we knew there was a gap in terms of funding startups and even the SMEs, right? And so which is why we started Leet Capital to sort of help these later stage startups and SMEs fundraise and grow. And so that's what we're focusing with Leet Capital. So yeah. So a bit about ECF. So for those of you who don't know how ECF works is it's basically giving the public, i.e. you and me, the chance to invest in private companies, which previously was not available. I mean, previously you had to be an angel investor or an institutional investor to invest in these private companies, but now you and I can do that. So that's the beauty about ECF, and the real benefit for I guess both the investors and the companies is that now your brand ambassadors, so your current customers, they can invest in your company and they can be part of the growth of the company as well. And vice versa as well, right? So your investors can become your new customers as well, your new brand ambassadors. And we've seen that in our past deals as well. Well, close to 40% of the investors in the robo advisor they raised on our platform, Accrue, 40% of their investors became new customers. So it works as a great indirect marketing tool. So that's the real benefit of ECF. You're putting your name out there in public, basically. The other thing about ECF is that you use a nominee structure. So it's a SPV, it's a special purpose vehicle, wherein we group all the individual investors into one nominee company. So if you're a founder today, if you're a startup, or even an SME, you're looking to ECF, you're worried that, okay, with ECF, you're getting the public in, there might be a few hundred people coming in. You don't have to worry about that. Your cap table will look very clean. It's just one nominee company, and that's our nominee company. So even when you do your shareholders reporting, your whether it's quarterly or biannually, or even your annual reports, right? You do it to us, and then we disseminate it to all the individual investors. So that's basically it for ECF on a high level, at least. So if this is something that interests you, or if even the two deals that you want to learn more about them, you can register as an investor on Leet Capital. You go to leet.capital, you click on sign in, click on register account, click on I want to invest, because that's how you register for an investor account. If you're a startup or if you're an SME and you wanna create a issuer account, you click on I want to raise, and then you just simply fill in your personal details a bit more, and this is where we do our KYC procedure. We need all this information, so please upload the front and back of your IC. And this is where it's really important for you to select the investor type that you are. So there's three main types of investors. You've got your retail, you've got your angel, and you've got your sophisticated investors. So retail investors well, I would classify myself as a retail investors, and then you've got angel investors, who are they might be seasoned, you might be new to it, but there are certain thresholds that you have to meet. So SE has guidelines on this, and it's typically, as long as your income's above 180,000 ringgit in a year, you classify as an angel investor. Then you've got your sophisticated investors who can be broken down into individuals and institutions as well. So institutions might be your VCs, might be your PE firms, they might be companies as well. And then your individuals will be very, very wealthy individuals. So usually it's above 300,000 ringgit salary or annual income, right? So once you select that, and that's pretty much it, right? So that's your dashboard. You can see all your previous investments, and any reports that you get from the companies all come here. And we will do our KYC procedure, and we will notify you once that's done. And that's pretty much it to register an investor or an issuer account. So we want to have two questions today. Just to gauge the crowd today, I guess. So the first one is whether do you have any experience of investing in the private equity market? So it could be ECF, it could be maybe you're an angel investor, you've directly invested in a deal yourself. And the second one is, have you ever been a part of any angel network? So in Malaysia, we have the I guess the most common one is MBAN, Malaysian Business Angel Network. So if you're part of that, you can let us know as well. If you're not, let us know as well. Just trying to gauge the crowd today. So I'll give you maybe a minute to answer these questions. Okay, cool. So I think majority of the crowd, and we've seen this in our past events as well, majority of you do not have experience of investing in the private equity space, right? So which is also good. So this is the purpose that we're doing this sort of events, to sort of educate you guys on what's the best way to go around it, the risks involved as well, not just the rewards, right? We always talk about the good side of things, but we also will talk about the risks involved with either in the private equity space at least. All right, so coming back to today's main, I guess, event. So we've got Shao-Ning here. Shao-Ning, as I mentioned, she was a previous entrepreneur herself. She exited the business, and now she's I guess the partner at Angel Central. So Shao-Ning, do you want to introduce yourself to our audience today?
Thank you very much, Justin. I think that was actually the poll response was very interesting for me to see. Okay, very good morning, everyone, and thanks again for taking time, and thanks 1337 and Leet for inviting me for this session this morning. Very quick self-introduction. My name is Shao-Ning. I was a founder for 11 years. So I was actually running Job Central. I started as a fresh grad. I think I didn't know better. So after I graduated from university, I decided to take the plunge, and I wanted to take control of my life. So basically, I started a .com business without really knowing what it was. Long story short, we couldn't get any funding. So I think that's something that is quite rare nowadays. I think founders or startups actually have this idea that, I need to get funding, otherwise I can't get going. Situation was very different back then, and I think I chose a very good time to launch my startup. I chose in 1999. I launched it in March 2000. We took about 6-7 months to prepare it, and the time we launched, March 2000, those more seasoned people within the audience, you will know that Nasdaq crashed in 2000 April. So it was actually the perfect timing for us to launch a startup, and partly because of that, and partly because we were a team of very inexperienced founder, fresh grads, and so there was no professional money that was interested in us. But we learned really fast that we had to really sell our way through. We had to figure out how to use sales to push the business. So good and bad. On hindsight, I think Job Central turned out to be what the Silicon Valley nowadays calls a cockroach startup. Basically, you really try to sell your way through and make sure that you use your cash flow to fund your business. But we were very lucky, and I recognize that luck is a very big thing in business too. you could try your best, but we were very lucky that we chose a business that's very cash flow positive. So I understand from Justin that within the group, we have quite a few SME business founders here. You will know that cash flow management is the key to make sure the business survives. So we learn our habits of managing cash flow very fast. And luck would have it too. Again, the senior people in the room will know that 2002, 2003 was a SARS period for Singapore and Malaysia. So again, that was a difficult period. Then the great financial crisis in 2008, 2009. So when running Job Central, we went through two very deep, in a sense, economic crisis because of the bigger environment. So it taught us how to manage during the hard time, and then how to write the situations, and how do you make use of whatever economic situations, and so that you become resilient, right? Then long story short, sorry, not so short now. We were very fortunate to be acquired in year 11 of running the business. And then we sold the business. And then after that, in order to find my purpose in life, I started just using the 10 years of experience in running the business and helping the startup within the Singapore and Malaysia ecosystem. And I kind of like shifted from this side of the table to the other side of the table. And I learned to think like an investor along the way. And what I was advising the startup, helping the startup, my mindset actually was more founder-centric because of my 10 years of habits and experiences, right? And I realized that was very helpful for me when I swap side to the other side. I start to see things more as an investor. And of course, the first few investments was painful because I didn't know better. And then I realized that while there's a need for angel investing, early stage investing, early stage funding resources, we were not very sure whether the market really knows how to angel invest, and whether the existing investors who are very used to public equity trading, the mindset can it shift. So we realized there's a gap. While there's a need, there's actually a lot of liquidity in the market as well. But is there enough skill set, enough understanding to really invest well as an investor? And that's where we saw a gap. And in that, I think so I exited fully from Job Central in 2014. So 2015, 2016, mugging around, don't know what to do with myself, just working with startups. Then we realized this gap in potential angel gap mindset. So we started teaching from our own learning lesson how we see angel investing. Of course, in that process, we also we started to manage our own portfolio. So when I say we, it's actually because I married my business partner in third year of business. So after that, when we exited together, we have a pot that we need to manage. So we learn about portfolio thinking, we learn about asset classes thinking, and we learn about the buckets thinking. So we started sharing that with the Singapore ecosystem, a community, and it's like a community that just came up from the ground. And we started sharing concretely how we do angel investing, and then it kind of like took hold, right? In 2018, we realized that we had a group of like 200 over people who were just coming together, and we thought that we should formalize it. And because at the time it was really just one day a month we were doing this, and then we saw that there was a demand for this, and that's why we decided to incorporate Angel Central then. And then I got in my husband, Shao-Ning, and then another partner, Mo, to work with us. And then now we have two full-time staff, Serena and Shirley, to be the backbone of the business, while the three old people like myself, we were just here sharing, and then hopefully that we can help push this ecosystem a bit forward. Because in order to help founders succeed, we need the angel investors to last. But we cannot have angel investors invest on a whim because of the high failure rate. If 10 cases you invest, 9 died, I think you also die as an angel investor. So how do you invest well? How do you go in and do your selection and due diligence is something that we are very mindful. But key thing is actually, I can share more along the way, but key thing that at Angel Central we advocate to our members is that you need to know what you're doing, and you need to be a patient capital. Yeah, so that's what I'm focusing now, and hope to share more with both founders and investors today on how to do this better using my own lesson.
Right, cool. Thanks for that very comprehensive background. So coming back to, I guess we'll keep Angel Central for the later part of today. Coming back
Yeah.
to building the business, you mentioned that you had a hard time, right, getting funding at that time, at least, right, back in the early
Yeah.
2000s, and a couple of fresh grads, like you said. We see that now as well, right, in a lot of startups. How do you think the funding landscape has changed then and now?
Okay. So background was .com crash, right? In April 2000. So the whole, basically the capital run dry for the early stage investing. So that was the background. Versus now, there's plenty of capital in the market. The liquidity, no thanks to, I mean, especially during the pandemic period, I think this time around globally, all the governments were pumping money into the economy. So on one hand, the bad thing is inequality widen. The effects of the cash from the central banks had a very widening effect. But the fact is there is a lot of liquid capital in the market. So the thing now is, are this smart capital or where are they going? So that is actually the key difference that I will see here. And on the other hand, I would also see that more investors are actually more aware of the benefit of early stage investing. But we need to be very careful of the risk level, because the fact is the fatality rate of early stage company, it's 7 in 10 within the first 5 years, if not more, right? So we need the angels to come in to have discipline themselves. They need to know very well how to manage their investable asset and how do they manage risk here. And of course, I mean, in the space, what we are most worried about is FOMO. Sometimes FOMO would actually move the valuation, because FOMO from the investor's point of view, just be very explicit here, sometimes it gives the founders a wrong idea. And founders might use it to push their own valuation. And so one of the key, I would say the key disagreement that now not so bad already, I would say key conflict that we see in early stage investing, especially within the tech scene, I would say back 4 or 5 years ago, is the fact that tech founders take the global understanding of what a tech business valuation should start with, not considering how much traction it has. Versus from the investors' point of view, and a lot of investors are actually seasoned business people, or we're not talking about the tech C-suite people. We're talking about traditional Asian business owners. So that's valuation expectation, there's a big gap. So because of that, there's a lot of conflict, and because of that, there's a lot of lack of choice of word, about misgivings from the experienced investors onto the new tech founders. So we need to help that understanding match, right? So I think that was a key difference. But founders nowadays, I would say regionally, there is an increase in valuation expectation, and that's actually an effect of spillover effect from the biggest startup market in the world. It kind of like trigger over. And I think one of the most well-known incubators of the world, with that label, valuation triple jump.
Yeah.
And I think Justin will know this very well. I think in the past 1-2 years, their international intake actually has increased a lot, right? They increase their cohort size, and once they increase the international cohort, the international cohort come back home with that triple jump of valuation expectation. So that the effect is very clear in the scene. So something that we need to balance. Yeah.
Yep. I guess we had another. I guess it ties back to my question on the business side of things, building job, your business, right? Someone asked this as well. Someone asked, what's the best way to get go safely, right? But is there really a best way to get go safely?
What is safely?
Yeah.
There's no. Yeah. So the thing is, honestly, I would think that it takes a certain craziness for anybody to put the foot forward and commit to become a founder. Yeah, for sure. There has to be that, both the ambition, the desire, and that willingness to go through that, and knowing what it is actually going to mean. I would say, I think most of us are actually migrants, right? Our grandparents are migrants that came into Southeast Asia. And during that period, it was out of no choice. It's for survival. But for our generation, I think it's more of, is it something that you really want to put yourself through? Because for me, looking backward, actually one of my very good friend, actually when she realized that I quit IBM to become a founder, after I graduated, she actually texted me from Toronto and she said, "Are you crazy? Are you throwing away a career and then just go into this roller coaster ride thing?" And then on hindsight, I realized it's not a roller coaster ride, it's a submarine ride. Roller coaster is there's a track, you know where to go, and there's booster, there's engine running, right? Submarine is there is an engine, but you don't know what direction to go, right? And so to me, a founder's journey in the first few years, it's really like something, right? It's dark all around. You don't know up, down, left, right. You don't know where to go. And if you cannot come out to breathe on your own, you don't know where your North Star is. It's actually very bad. And sometimes in the summary, right, you're trapped with people who are not aligned with you. How do you manage that, right? So there is actually no check. I mean, there is a checklist to know that how you prepare. But even if you check all the items on the list, I think you're at best 60% prepared. Right. So it's really how fast you learn, how well you learn, and how fast you react. And unfortunately, sometimes you could learn the wrong lessons along the way through your challenges. So there's no way. I don't think there's a sure way.
Yeah.
There's a safe way. Safe way is find a job. Right. And there's no safe way. But I think come in with the eyes open. And I know that, I mean, for me personally, yes, I have a good outcome. But I would say I totally do not regret the decision. And I say that it's actually a very good learning journey for me as a person.
Yeah. And I'm sure it's spilled over in having to start how to angel invest as well, right?
So it helped me connect with the founders, and it helped me and help the founders be more willing to open to me about the problem, because there are some investors who actually so while the investors meant well, I would like to think that 80% of investors are on the right reason for wanting to invest in the startups. But there are some founders who actually feel that I don't want to share the bad news with my investors because I don't want them to know that I'm struggling. I want them to, so it's what we call the fair weather founders, right? They only give you share the good news. But I would say I would really encourage and all the founders here to have regular contact with your early stage investors. And the thing is, leverage them on their experiences. Sometimes even basic things are networking, how you read your stuff and all these things. Leverage on our age, at least. We will at least know how to read people slightly better. So in a tough situation, how do we deal with it? Of course, don't come to me and say that, how do I do this? Come to me with, I have this situation. This is what I'm thinking of doing, options 1, 2, and 3. Then let's discuss the pros and cons of 1, 2, and 3. Right? Don't go to your investors saying, what do I do? But go to your investors and say, these are what I'm thinking. What do you say? Then you come to a better, more considered option. Yeah.
Okay. So how big is so now talking a bit about Angel Central, right? So how big is your investor base currently?
Oh, you mean the number of members that we have?
Yeah.
So just to be very clear here, Angel Central is an investment club. We are a membership-based entity. We have 140 plus paying members. 90% of our members are individuals. So it's what Justin was saying, it's more AI investor, accredited investor themselves. About 10, the other balance of them are family offices, meaning they represent a group of families to manage their wealth. Okay. More than half of our investors actually invest money. So it's very, I mean, the way the model we have is, we are more structured angel investing. Our members could either invest directly onto the startup itself, onto the startup's cap table, or when the startup are looking for a bigger round, we could form syndicates to support the startup. But our basic style is we always would need a member to step up as a lead angel to lead that syndicate. So to date, since we formalized in 2018, so 2018 to now, we have featured almost about 100, so 40 times 4, about 150 to 160 startups on our platform. On an annual basis, we review between 700 to 800 companies. And out of this, those that we believe are suitable for fundraising will be pushed onto the platform for our members to discover them. And, oh no, my phone. And then our actual investment from then to now, based on tracking, we've invested about more than $20 million Sing dollars into the startup itself.
Okay. Okay. So the reason why I asked
Sorry,
you...
I need to run 1 second to turn off my phone.
Sure.
Okay, I'm back.
Okay. So the reason why I was asking how big your investor base is on Angel Central is because trying to understand the behavior of these investors as well, right? Because we obviously have our base as well, whether it's from our VC or from our ECF platform. And so the question I have is, are there specific industries that these investors want to see that they've reached out to? Because when we reached out to our investors and we asked them, is there any specific deals that you want to see? They said, no, just show me something exciting and I'll see if I like it, right? So wondering if it's the same over there, or is there specific, maybe it's the hot industries like fintech that the investors like?
I would say for any investor, they would have their idea of what they want to invest in. But for Angel Central as a club, I don't have a sector focused, but we do ask for technology based or scalability based, the ability to scale, and that possibility, the optionality to scale must be there for the chosen industry the startup is in. And the reason why we are sector agnostic is because, first of all, as an investor, you have your personal preferences. Let's say you are a lawyer, you probably will be you will know more about legal tech, compliance tech stuff. But then from risk management, you cannot only be in that space. The same reason why even for the public market investment, you will not all choose in the same area. I mean, pandemic period, if 100% of portfolio are in tourism related industry, I don't think you are smiling at all these few days, right? So risk management is something that we talk about a lot. And so within your portfolio, you should be diversified. You should be, and so from our point of view, that's why we are sector agnostic. By showcasing different startups from different vertical, we encourage the investors or the angels to explore and discover. But we understand that, I mean, for me, my background in job portal, my background in e-commerce, I'm very comfortable with this, and I'm very comfortable with B2B related business. So when you talk about med tech, hardware, I don't know how to invest, right? But it doesn't mean that I don't touch. So my very first hardware investment was a total flop, right? But the thing is, I need to learn about it. So in addition, just now I mentioned we actually started doing a lot of angel investing workshop. So the second series of workshop that we came up with was a deep dive workshop. So every quarter, Angel Central will run a deep dive workshop on a chosen topic. So we have done clean tech, we have done biotech, we have done HR tech, we've done property tech. So every year we have 4 topics. So this this deep dive series are always led by either a Series B or C founder or VCs who are experienced in that field to do an initial 40 minutes keynote sharing their insights and how they see this particular space will go. And then it'll be a panel about 4 to 5 relevant people from the space to learn more about the space. But of course, after learning that, we don't say that you straight away go invest in the space. You should still discover and learn more. So typically we recommend our angels after listening to like 5-10 pitches, then you cut your first check. Yeah.
Okay. What about yourself? Any specific industries that you favor?
No. So diversification, that's why. So one key thing that personally, between my husband and me, we have 42 angel investment. It's representing about 7% of our investable assets. Then the other 50% of my early stage investment are through VCs. So I have another 7 investments in early stage VCs. So my 42 angels are mostly Southeast Asia. My furthest away that I went to was Helsinki, but then I realized I didn't understand the tax system there. So it would really need to do very well for me to make a profit in that case. But I think personally, I recognize that the fact that I need to diversify. So asset classes, we diversify. Within angel itself, we diversify. Within PE itself, we diversify into early stage, late stage too. So it's risk management that you, as an investor, the key concern you have is managing a risk. So how do you manage your risk? So you manage your risk by portfolio, by sizing, time frame.
Yeah. Okay. So I guess every angel investor, you're an angel investor yourself, right? So every angel investor has different things that they look for in a company, right? Whether it's the team, the product. That's what I was asking about, the industries as well, any specific ones. So what's your take on that? What do you look at specifically if a startup comes to you? What's the first few things that you look at?
Okay, it really depends on the age of the startup. So if it's a startup that is under 2 years old, what I look for is more of the founding team, the complementary skills, the size of the team, how far they come together, their interaction. But if the company 3 to 4 years old, that people related thing plus traction, because the traction will be very clear. So by now, traction is important. Early stage, I will look at more product development and their insights and why are they in that space. Of course, the space that we are looking at, I would say I want to see spaces that has a potential to scale, but I'm not 100% moonshot in that sense, because I believe that founders, you come in with a certain belief in making a change in the chosen space. But if it's not a wrong space, but if the potential is not high enough, I believe a strong founder will be able to pivot and learn and move, be nimble enough to find the next potential space. Of course, the adjacent spaces must be relevant based on the original intention. But I would be concerned about, so for me, because but this one is actually more personal, right? Because of my background in .com and in web-based businesses, we are very attuned to high EBITDA business. So when I look at a business that has low gross margin, when I look at a business that EBITDA, very negative for like 5 to 10 years projection, the type, I get very uncomfortable. So on one hand, I know that as angel, we need to be patient, but is the patience a 5 to 7 year patience, or is it something that is 10 to 15 years? There's a difference, right? So you need to, as an angel investor, you need to know what your profile is and what your list is. Put it this way, when you go into any long-term relationship, you need to know what you're looking for, and you need to know what your counterparty is supposed to be like. So you need to have that awareness. Otherwise, it's like I would say the previous generation, some of the angels, they go in and say that, hey, where am I getting my dividends? It's just not a topic that founders can entertain, right?
Yep.
Yeah.
Okay.
Yeah.
So if let's say it's an early stage startup, right, that comes and pitches to you, but let's say it's only one founder. There's no other co-founders in the team. Personally, would that be a red flag for you?
Yes, to some extent, but I would not rule it out without meeting the founder. But so as a founder, you need to reverse due diligence your counterparty that you're talking to, because there are some investors who say that I would definitely not invest in certain profile of companies. So you need to know that, so that you don't waste each other's time.
Okay. So what are the other, I guess like you said, between the husband and you've got what 40 plus investments.
Yeah.
So what are the common red flags that you see there when startups come and pitch to you?
First one is I would always like to at least have a second and third meeting with the core founders.
Yep.
And I would like to pay a visit to the office when I can. So it was actually a habit pre-COVID. Now I got to make do with Zoom. Then because I want to get a sense of how the team work together and whether there are any things that we can pick up on and be very clear. And then I will be very explicit about, I want to know whether what you claim to be your shareholding is actually reflected on your cap table. And then that's one thing. And the other thing is actually really through conversation, understanding their conviction, understanding where they're coming from. And I would say the biggest red flag that personally for me is really a no-no is that sometimes you realize founders, they do not have strong conviction in what they intend. So it's a fine balance. Strong conviction, but be willing to defend your conviction and to convince people about your conviction. It's the ideal case. But if you're so stubborn that you cannot hear feedback, that's also the other problem. Then the third case or problem is some founders are like, you tell me what to do. I'll do whatever you want me to do because I want your money. Then I'm like, that's not the reason why I invest, right? Because the fact is, as an angel investor, you're not more than 2% of the investment. So if 2%, I need to be the one coming up with strategy, I think I need like 72 hours a day.
Yeah.
So that's not a good way to, so for me, it's really sussing out the founders.
Okay. And have you invested in a startup with just one founder?
Yes.
Okay.
Yes. Okay. Yeah.
Okay.
Yeah.
Okay. Yeah. So I think even for us, when we see one founder, we do see it as something to take note of. It's always I guess it can be seen as a red flag, because what happens if that founder is gone, right? Then there's no startup left.
Yeah.
Okay. So we talked a bit about, I think you talked a bit about valuations as well, right? The moment you have that sticker from a certain incubator from Silicon Valley, the valuation triples. But I think generally as well, right? We've seen so many tech-related startups, which is the majority of them that we see nowadays. They come with crazy valuations, right? A lot of times, most of them are overvalued. So what are your thoughts on that? How do you sort of gauge valuations? How do you come up with a figure and tell the founder, look, I will only stick with this valuation. If you want to meet it, I'll fund you. Otherwise, I'll walk away.
So far, I've not done that. I think what I get more is more of, this is founder saying that this is my valuation, but I really want you in, so I will give you a 60% discount. I really appreciate it. But I actually do get uncomfortable with this kind of, so usually I've not done any of such deals, to be very honest on this part, because I feel that if I'm not going in on the same term as the others, I find it a bit awkward. And for me personally, not that I don't want a better deal, but I do, because I'm a salesperson, right? When I do Job Central, my key role was actually selling our services. So I'm just wondering whether when you're doing this, how do you subsequently continue running your business in the sales and how you handle your people? It's like there's going to be a lot of backroom deals. And so for me, on the value system wise, I'm not too comfortable with that. But coming back to the valuation, so between Desheng and me, we have a list of items that we must both be comfortable with. So in terms of valuation, for us, ideally, a pre-A company blended valuation don't go beyond $8 to $10 million US dollar. So that's where both of us are comfortable. But we recognize that since we started in 2011 to now, in fact, triple jump for YC, it's not, I think one of the most recent one I saw was like 20 mil asking USD, freshly graduated from a cohort. So it's like 6 times what we are seeing in Singapore for the same stage of company. So it's crazy, right? So but some investors are comfortable with that. They feel that with that label, they're not going to have problem fundraising in the US itself. And that's why the founder deserves that. Not wrong in that thinking, but for me, I'm always concerned about if the company is fresh off the ground, they need to start it off. If they're going to be in a brand new environment that they're not familiar, if they can fundraise, I think great. But then the thing is traction got to come, right? So those are actually things that I would consider. And I would say that, so key thing is FOMO lah. Don't think that because everyone is doing, then just go into do it. End of the day is you must have the discipline. And besides, there is always a next deal. I mean, in angel investing, I mean, I have my misses too, right? I mean, there were many deals that I missed out, and there are also many deals that I put in and then it's a wrong selection. So out of my 42, I think I have maybe 7 zombies. They're still going on, but then you will not see the uptick. 5 actually written off already. So I have about 25 of them post-COVID. They are still growing strong, but out of this 25, you got to see how things work out, right? So by keeping to your discipline, at least you can tell yourself as an investor, I did my part. I would not regret that choice.
Yeah, I think people have that I think FOMO is a big one. In fact, recently I was watching Shark Tank, and one of the sharks said, startups are like buses, right? There's always the next one coming. There's always a deal on the table continuously. So you need to remove that FOMO factor. But someone actually asked about this as well in the chat, right? How do you measure the FOMO element to decipher the real value? Any examples of how this is done, if you can even do that?
I would like to say that so far I've not done any investment because of FOMO. So for me, my process is really, first of all, look at the deck, ask a bunch of questions based on the quality of the answers, and also the efficiency of the answers. Like if I send it to you and you take a month to come back to me, this founder is just not managing the time. Right? Here I get a sense. And if the person start to name drop me and say that this guy is coming in and that guy is coming in, but I cannot see the traction, then I would not be in. Because usually for this, the valuation, unless this is like the founder who has the 5th positive exit, then maybe we'll have a second look. But so far we have not seen that. And founders, I think at least within the Singapore ecosystem, the founders are quite clear that we are not the crazy chaser type. And
I think we've seen this on our side as well. A lot of investors invest because of the FOMO. They think that it's going to be the next best deal, and I'm sure some of them don't even read the term sheets, right? So it's very important, I think, for the investors today that you do your own due diligence. Make sure it's something that you're comfortable with before you put your hard-earned money in a startup, right?
And also another thing about angel investing, right? I don't recommend it to be more than 5% of your investable asset because of the high risk element. So put it this way, if you need to write off the investment, of course you will hurt for a day, for a week. But if it's going to hurt you more than a month, it's going to affect your quality of life. Think again about whether you want to enter this space.
Okay. I think we had a question from August as well, asking how he can apply to be on Angel Central. So I think Serena's put that in. If you want to reach out to Leet Ventures as well, our team will let you know how you can do that. We had another question from Yong Lin. So Yong Lin's from Crave. He said he's met your husband Dershing, and he's actually one of our portfolio companies as well. So he asked, when evaluating traction, what's the weightage of month-on-month growth or year-on-year growth?
I don't think we can actually put a value to that, but it's more of the general trends that we're looking at. So one core belief that I have is the founder who are in the business should always know better than us. So in my process of due diligence, so in the meetings that we have with founders, right, we actually always try to understand how they grew, why they chose to do certain things certain way, and what's the rationale behind that decision. And in the process of due diligence, my philosophy is more of checking to make sure that what they claim is there. So if it's not there, then is it just pure talk and saying for the sake of saying? So that is actually more that. But month-on-month growth, I would say a bit difficult to see. I won't put too much on that, but the general trend should be there. The shape of the curve should be there.
Yeah.
And whether we're going to talk about 10% month-on-month or 30% month-on-month, I think it's for early stage, it's actually very difficult to see. But for year 3, year 4, I would want to see it.
Okay.
Yeah.
And we had another question from August, and I think you touched on this earlier as well. So, as an angel investor, are you interested in getting dividends, or is it just long-term equity growth, capital gains?
I think we'll be kidding ourselves to say that we are not looking for returns. But for angel investor, the key thing is you need to know that this investment asset class is not something that is not liquid, and it's not going to be easy to get an exit. So when the exit comes, it's going to be 5 years down the road. So it's actually one thing that I'll also look out for. If the founders are saying that I want to flip a business in 3 years, in 4 years, we know that they're not being realistic. It happens, but first of all, it probably won't give you the multiples that the angel needs to have from the portfolio thing. It's also basic mathematics. When you invest in your open market share trading, for a stock, 3, 5, 6% per annum return, it's decent. Some will even claim your 10 to 12%. But for early stage investment, you need to look at multiples. So in the 5 to 10, because of such high risk that you're putting, a sensible angel investor will be looking for at least 20x to 25x of that case, of a particular case. And it's because you are balancing out the high failure rate within your portfolio. And that's why we tell our members that if you want to do this proper, you must have a time horizon of 5 to 7 years, portfolio of at least 20 to 25. So which means you invest 4 to 6 cases a year over 5 to 7 year period, and consistent bite sizing. You cannot say that I feel good about this one, I put 100K. That one I'm not so sure, but because so many people are putting in, I put 20,000. Then does it mean that you put 4x money here, you're going to put 4x time to support here? It's not, right? Because you have other things that you need to, and besides a portfolio of 20 companies, you're not going to really be a chairman model where you really devote 30% of your time on them. It's just not going to happen. So it has to be something that you're comfortable being a bit more passive, active when the situation calls for it, or you have some relevant countdown that you want to share. It cannot be something that's going to take up a big chunk of your time. As an asset class, it takes your time, but individual companies shouldn't be taking up that crazy amount of time for you. But if you see it as the way that, I want to trade in and out, unfortunately, our ecosystem has not arrived there yet. In the US, you have secondary market for early stage trading, not for our ecosystem.
Yeah. I think that's why I guess I'll plug ECF in here. I think that's why with ECF, that we're already developing the secondary market. So it's sort of complementing that part of it, allowing investors to trade this private equity. But there's still a lot of work that needs to be done there. It obviously won't be as liquid as your public markets. So okay, and we had another question from August as well. I guess I'll generalize the question that he asked. Are there specific KPIs that you look for when you look at a startup's traction? I guess it would depend on the industry or the nature of the business as well, right?
Definitely. And so for me, being more a finance person, I would definitely look at the numbers. But I would say KPI is something that I have definitely a certain data that I look at to see growth. But the KPI should be defined by the founders. Of course, generally, if you're of certain sector, you need to have certain KPI. You cannot kill yourself to say that this kind of KPI doesn't matter. Like your user acquisition for e-commerce site, you cannot say that the engage, the session duration doesn't matter. I mean, you'll be just blind, right?
Yeah.
But I would say end of the day, I would expect the founder to set a KPI and to show to be very transparent in saying that which one is meeting, which one is not meeting, what am I doing to push for growth in this. So for me and my companies, we actually, I mean, I have a structure with them on a monthly basis. I want an email update. I don't need to talk to you every month, but if you have a problem, you can call me anytime. We can schedule a call, but I want an email updates on what's happening. But of course, one key item I always have inside there is how is your bank balance doing? And for companies that's really issuing invoices, I want to know how your aging days are doing. A lot of founders feel that, especially the tech founders, they feel that I'm non-finance people. I just know the bank balance, but I don't care about my cash flow. I think that one should die. Actually, I want to address one question, the add-on to the part that August was asking about growth potential, right? I think from the investor's point of view, sometimes you need to be flexible as well, because certain economic situation will push for things to be slightly different. So on one hand, you diversify by having a portfolio approach. You also need to know generally how the particular sector is doing. And so that you do not give yourself undue expectation, and then you do not give your founders undue stress.
Yeah. I guess coming back to we got a couple of minutes left. So coming back to the valuation part, right? So Yonglin asked, it's something that we see a lot as well. So do you use a valuation when you calculate the valuation of company? Let's say it's a revenue multiple, right? You have to use a revenue multiple if it's an early stage company. Do you do it based on the current numbers of the company, or do you do it based on the future projected numbers?
For us, we look 1 year forward, the forward numbers, but then of course we bear in mind whether the forward number is realistic or not. Yeah, but that will be something that is really more doable for company that is really 3-4 years old. First 2 years, the pattern is actually not there. So sometimes we would just use the multiples from the more developed space to get a sense.
Okay.
Yeah.
Is there a reason why you do 1 year forward and not the current numbers?
Because for us, we always look at the current MRR, and then they will always use the current. So it's actually more, I think it's more the VC styles nowadays, a bit more aggressive, right? You use current MRR, or you use the previous quarter, then you times 4. So that is always forward looking.
Okay.
For me, that is aggressive. It's actually aggressive. So you actually need to be a bit discounted a little bit. And so for us, sometimes if I'm interested in a particular sector, when I know that business in that sector, I will look out for news for that sector to know whether that is comparable.
Okay. So coming back to that, and do you have like at least for you guys, at least personally, or even Angel Central, right? Do you guys have a rule book or a guideline in terms of, if you're in the healthcare industry, you use this multiple; if you're in e-commerce, you use this multiple?
No, because for early stage, it's really different yardsticks for different investors. And so in the open market, our style is more value investing.
Yeah.
Right. So it's going to affect how you see things. So I mean, for me, of course, something just freshly launched and asking 20 million valuation is definitely out of whack for me. Yeah. But we have some members who are actually a lot more liberal. So it's not something. So that's why actually for us, when we do our vetting on whether we decide whether a company will be featured on Angel Central platform, the first cut is really the quality and caliber of responses that we get, not so much evaluation and asking term, because we have to recognize that not everyone is that conversant about how valuation is done at this space. And besides, that is a negotiation thing also, right? But of course, a VC is leading around, we will expect that portion to be well done.
Yeah. Okay. I think we just got time for one last question, and I think this is a very important question. Is successful startup investing a skill or a luck, or both?
I think it's both. But so this part I need to emphasize. Angel investing for people who are interested in angel investing, right? Ideally, you're not here purely for financial returns. It must be because you're very interested to learn. Because it's quite time consuming. No? If you are really going to do this well, you must be very interested in people, and you must be good at Googling, and you must have a damn good bullshit meter to know what is bullshit and what is not bullshit.
Yeah.
You need to be able to see through this stuff and to know whether this is really the this group of founders I want to support. Because there are times that they may look very good. Then 6 months down the road, they tell you that we break up already. And you know, founder breakout is top 3 reasons why startups do not survive.
Yep.
So that is actually the part that and I see it as a pay forward, because I think a lot of times people get into become a founder because of, you know, certain ideology. And unfortunately, I would say certain group of people think that it's a very romantic position to be in. Unfortunately, it's a very, very stressful romantic relationship that you get in. And you do learn quite harsh real life situations in that journey. So to be an angel investor, ideally you can support the founder through that. But it's also because you are really interested in helping the founders, because founders really have not an easy life. So I applaud the founders who make this crazy decision. And ideally you have people who really believe in you as a person, but not blindly. And so if people choose not, if the decision is not to invest, just know that it's not you. It's a financial decision. But another message I want to push out also is for professional early stage investors, return is still the ultimate aim. So it's still a mathematical decision. So do not take it personal, put it this way. And when you're not receiving venture funding, doesn't mean that the business is not worth it. Yeah, don't make it as a label on yourself.
Yeah, I was going to ask you, any final advice for the
I did it before you asked me.
Yeah, but maybe something for the entrepreneurs in today's session, right? Any final advice for them?
So I'm going to use one term that I learned is that you always need to re-engage yourself. You always need to re-engage your co-founders, because alignment of the team is most important, and alignment with yourself. It's not an easy journey. So if you're not at ease with yourself after a couple of years, you need to be honest about it. But you also need to be responsible to make sure that the people who are on it with you are aware and transition well. Failure is not unavoidable, but failure is not something to be ashamed of. I mean, what I didn't share, actually, you only hear about Job Central and Angel Central. Actually, I have 2 failures along the way. It's just, you learn along the way, and then take the failure with you and learn from it.
All right, thanks so much, Shao-Ning. I think that's the end of today's session. So thank you once again for coming and blessing us with your wise advice, I guess, the experiences that you've had. I definitely learned a lot as well.
Thank
so
you.
Hope everyone in the audience today learned a lot as well. So if you've got any feedback for how the session went, please do let us know. We love to hear maybe even stop the next topic that you want to hear about. So do let us know over here. So thank you again, everyone, and happy Friday.
Good Friday. Happy Friday to everyone.
All right.
Take care.
Thanks,
Bye.
Shao-Ning. Bye-bye.
Thank you.